Everyone wants to find that one ETF that's going to crush the market this year. Today, I'm going to show you the high potential ETFs that the market has been talking about, and I'm going to share with you why they're so popular and whether they can actually beat the market. In this video, we're going to break down exactly how these ETFs work, what makes them unique, and if they're a right fit for your portfolio. I won't just show you what they hold. There's a specific way in which they are trying to get that extra edge in the market, and I'm going to show you how they compare, what you get for your money, and if any of them could be your ticket to outperformance, not just this year, but for many years to come. Let's start with JEPI. Now, JEPI is JP Morgan's equity premium income ETF. This thing has exploded in popularity, and I get exactly why. People see an 8.5% dividend yield and their eyes light up like it's Christmas morning. The expense ratio is higher than most ETFs at 0.35%. Now, you might be wondering, how do they get this 8.5% dividend yield? I'm going to get into that just shortly. It launched in May of 2020, which is right after COVID, and right away, people were calling it the SPY alternative. And SPY is the S&P 500 ETF. Now, what's the goal? The goal is to own low volatility, value-oriented, large cap stocks. Companies like Microsoft, MasterCard, they say NVIDIA, which is not really low volatility, Amazon, Meta, and Alphabet. And then here is the trick of what these ETFs are doing. They sell covered calls on these holdings to generate cash. Guys, if you're new to our channel, I love selling covered calls. I've actually been doing it since end of May 2020, the same time that this fund has been around. The income is then distributed monthly. And since its inception, JEPI has returned 11.4% annually. But here's the issue. SPY has done between 14 and 15% annually. Now, guys, when I talk about selling covered calls, I do it in a very systematic way. I do it as a way of adding premium to my portfolio. But the big key here that everybody has to remember is you've got to be careful that you're not losing return, because the idea behind a covered call, for those of you who are new to it, is I have a stock, and that stock is sitting here. I'm going to sell somebody the right to take that stock away from me at a future date and at a higher price. So guys, let's use Microsoft as an example. I pull up Microsoft here, and something that's in our software, our options chain. I'm going to pick a date in the future. Let's pick October 3rd. It's about a month from now. Here are the calls on Microsoft. Now, the great thing our software does is over here to the right, it's going to show you the annualized return on these options. That way you can pick specifically based on the delta and the annualized return that you're going to get on this company. So let's say you want a 7.5% covered call. Well, that would take you to a strike price of $530. It's going to pay you $3.13. So in that time, between now and October 3rd, if the stock stays below that 530 level, you keep the premium absolutely for free and you keep your stock. The risk is that it goes above 530 and you lose your shares. You still get to keep the premium of $3.17 or whatever it is, but you'll lose the share. So let's say it goes to 560 suddenly. Guys, you got all your gain up to 530, you keep your $3.17, but you lose everything between that 530 and the 560, and your shares get taken away. So for all of these ETFs that involve covered calls, that's the risk. For those of you out there, what I do is I have a basket of 30 companies, and I sell covered calls at low deltas. What's a delta? It's basically the chance of that strike price being hit. My goal is to add premium, and I'm not trying to make a killing. I'm trying to make 2 to 4% extra a year. That's a lot. But there's a lot of people out there in the covered call community who would say you can make double-digit extra on your premium. Maybe. And we've had months where we are on pace for double-digit. But overall, I'm shooting for 2 to 4%. Have I beaten that? Yes. Is that ample for me? Absolutely, because we've shown people how 1 or 2% a year can drastically change your returns over a 30 or 40-year period. ETF number 2, JEPQ. Now, this is a younger, tech-hungry sibling of JEPI. This one launched a little bit later, May of 2022, and just like JEPI, it's got the same game plan. Own big names, sell covered calls, generate income. But instead of boring old value stocks, JEPQ is all about the NASDAQ 100. Apple, Microsoft, Nvidia, Amazon, etc. These are the big tech darlings. You still get a juicy monthly income stream, and you're also paying that 0.35% expense ratio. And JP Morgan still slaps on the marketing to make it sound like you're getting growth with income. And guys, since its inception, 14.4% annualized return. Sounds awesome, right? But hold on a second. That performance is starting from May 2022, right when tech was coming off the start of a brutal sell-off. Of course, the returns look great, but context matters here. Since the start of this fund, with dividends, it's up 55.6%. The NASDAQ, though, the QQQ, is up 75%. So again, an underperformer. But guess what? Depending on your situation, you might be okay with that to get that big dividend yield. Again, just like most things in life, if you do it on your own with enough discipline, you can probably do better than that. Now, my thoughts on this is high volatility companies, it's a risky bet. You're probably more likely to lose the shares as you do it to sit there and get that premium. But again, it's whatever makes everybody happy. If your goals are to generate that extra cash flow while having a little bit of capital growth that you sacrifice on, more power to you. It's a great way to hedge. Selling covered calls is a great way that when we have a bear market, you can decrease the loss. Because if the market's going down and you're selling covered calls at a higher price, you're more likely to keep your shares and get that extra premium. On JEPQ, I do think the NASDAQ is massively overvalued. So if we have a massive NASDAQ sell-off here shortly, having this would be a great hedge against that. ETF number 3, SPYI. This is the NEOS S&P 500 High Income ETF. It was launched just a little bit after JEPQ in August of 2022. And this one came out swinging with one clear promise: high monthly income with a 12% yield. And it's trying to do it the tax efficient way. Sounds awesome, right? Fat yield, monthly checks, and Uncle Sam takes less. Let's slow down here though. Let's actually look under the hood. SPYI writes covered calls on S&P 500 names, just like JEPI. But here's the twist. They're using index options and packaging the income in a way that leans on tax advantage distributions. Think return of capital as opposed to income. The idea is to hand you income without immediately triggering the tax man. That's cool in theory, but the expense ratio, guys, almost double the other two, 0.68%. That's real money coming out before you get yours. Performance since inception, 13.6% annually. Not bad, especially considering it launched during a rocky time in the market. But again, we're starting from a low base here. Let's not pat ourselves in the back just yet. Now guys, there's VOO, there's QQQ, there's SPY, there's SCHD. These are great places to go, and I really encourage everybody, do this the way I do it. Focus on your ETFs to meet your goals. If you want to buy individual stocks, buy them on the extra money. And I absolutely love selling covered calls. But this is actually one of those places where I actually wonder if there's a hindrance to doing it in a fund. All three of these ETFs are trying to do a distribution yield versus the dividend yield. Now, the difference between distribution yield and dividend yield is, as I've talked many times before in past videos, a dividend yield is double taxation. So I always laugh when people say, oh, people tax so low on dividends. Well, yeah, they should be, because the company already paid taxes on that money. And then when they give it to their investors, they're taxed again. With a distribution yield, it's pre-tax. That is the efficient tax basis for distribution yield. Now, the hard part is when you're looking at comparing these ETFs to SPY, they're not looking at the distribution yield. They're looking at the dividend yield. So it's really hard to get an apples to apples comparison there. Because it's tax efficient, you're not really looking. So even though all these ETFs have shown underperformance, the real performance might actually be better on these covered call ETFs. It's a tricky way to look at things. As opposed to if you had it in your own portfolio and you're selling covered calls in a disciplined manner, you can sit there and absolutely keep track. Now, covered calls are ordinary income. And I'm gonna hear people say, oh my God, I have so much. Well, do it in your IRAs and your 401ks if it's allowed. Absolutely, you should do that. And that money can grow tax-free for a very long time. But the key here is when you're ready to retire, If you're able to learn how to sell covered calls effectively, you could essentially sit there, take your dividends from your stocks and sell covered calls and live off that money completely. I personally like learning about options myself. These covered call ETFs, I don't know, just something's not adding up with the distribution yield and the dividend yield. I have to do more research to understand that, and so should you. Now, guys, you've seen the ETFs, you've heard their stories, you've seen their returns, but I'm not satisfied yet. How do they compare directly to the S&P 500? So I decided to peel back one layer and figure it out. Guys, this is the hidden side of investment success. You have to do your own research if you want to beat the market on your own. Following trends, headlines, or random tips will not give you outsized returns in the long run. Sometimes you have to spend some time on Google reading through documents, but the way I see it, that's a small ask. Don't be afraid to do that. Think about it like this. The more information you have, the better your thesis will become. So guys, after looking at the data, it's pretty clear that the total return is actually lower. And I did a little research, and according to what I found, the total return does include those distributions on top of the dividend. So I'm looking at this saying, what is your goal here? If your goal here is to generate cash and only cash, might be a way to go. But isn't the total return what matters? Yeah, you might have more volatility, and we'll see what happens during a down market because covered calls are an effective way to hedge a little bit during down markets. But like I've said before, I have found for myself that being very active with my options and making sure I don't lose shares, that's the key to making money. I would rather make 2 or 3% and lose a lot less shares than make 8 or 9% with a high risk of losing my shares. That's what works for me. But everybody's different. Everybody's in a different stage of their life, and everybody has different financial goals. But again, for me, what I'm most concerned about is not losing the upside of my shares and also generating just a few extra percentage points per year. That can make an astronomical difference in your retirement, and it should not be dismissed. Don't always chase yield. Chasing yield can become a very slippery slope. Just like companies that pay a high dividend but can't afford it. Now, granted, keep in mind, we've been in a major bull market for a large chunk of this, and that makes covered call writing a lot more difficult to make a good alpha, a good premium on the market. When the market, if we all of a sudden had a 3-year bear market, my guess is that a covered call strategy would be highly, highly effective. But if you are interested in learning more about covered calls, I have a free PDF down below. Click it. Within a minute, we will send you our free PDF to give you an idea of how to sell these covered calls. And if you want to buy stocks on this as they go down, you can sell cash secured puts. Now, guys, I've loved options. This is something that I wish I'd learned 25 years ago. I think it absolutely would have changed the way in which I invest all along the way. And I'm thankful that I learned it at the age of 38, 39 in 2020 versus later on in life. Now, there is a way to potentially beat the market while only investing in ETFs. And it's not some gimmick. These are very ordinary ETFs. So click the next video to see the 3 ETFs that I think could easily beat the S&P 500 over the next 10 years, because great investors don't just settle for average. And in this video, you're going to learn a simple way to beat the market potentially using these 3 ETFs. Thank you for your time.